Welcome back to Alpha Recap, your after-hours deep dive into the market moves that mattered. I'm glad you joined us. As always, if you have questions, you can reach us at stockalpha.ai and ask us directly.
Thanks for having me. Excited to walk through what was a very eventful day across sectors.
Markets closed with pretty mixed signals on March 23rd. Not a single narrative, but a bunch of concentrated stories. Tech and AI kept the bid. Energy bounced on geopolitical headlines. Utilities and storage showed some upside. And then crypto had that sharp, ugly episode. So, what really stands out here is the split between structural leaders and idiosyncratic blowups.
Yeah, that tracks. The day felt like two markets at once. One driven by AI and modernization, and the other by specific shocks and policy moves.
Let's start with the biggest pain point, crypto. The headlines were stark. A $25 million exploit and a stablecoin collapse that cut values by roughly 70% in some cases.
That exploit really set off a chain reaction. It wasn't just a headline. It created immediate liquidity stress for protocols that were already thinly capitalized.
Right, and the market response was clear. Risk off in small-cap tech and fintech-adjacent names, and a tick up in risk premiums across the session.
The confidence hit was significant. Data suggests institutional players will reevaluate custody and operational controls, and analysts note a higher probability of enforcement and regulation in the months ahead. Short, sharp lesson. Operational risk can translate into huge valuation moves when liquidity is tight.
Switching gears, tech was an outperformer again. The AI story kept money flowing. Big conversations about advanced models, claims around next-gen capabilities, and even supply chain modernization spending cited at about $4 trillion in the briefings.
I mean, when you step back and look at this, AI spending wasn't isolated to semiconductors. We saw industrial firms talking automation, consumer names rolling out AI search, and healthcare pilots for clinical efficiency. It's a cross-sector capex theme.
Absolutely. And that helped lift chip and cloud-related names during the day, even as other pockets of the market were under pressure.
Right. And the other thing is, the narrative feeds M&A rationale too. You saw that in the consumer space with the $1.2 billion deal that came through.
Danone's $1.2 billion move to buy Huel. Big splash. Not earth-shattering, but it fit the day's consolidation theme.
Exactly. Deals like that signal investors are pricing scale benefits and distribution synergies, which matters when margins are under pressure elsewhere.
Energy was another headline generator. Benchmarks moved up after outages in Libya and some analyst upgrades. Goldman Sachs pushed targets higher, even while the EIA commentary flagged potential oversupply in 2026.
So you had this classic near-term versus medium-term tug. Near-term supply tightness pushed prices up, which helped producers and capex conversations. But the deeper models still show the possibility of a surplus down the road.
That dichotomy mattered for other sectors too. Transport-sensitive consumer names saw margin pressure, and utilities talking about transition capex suddenly felt more urgent.
Higher fuel costs were a real-time input for freight and retail margins, and that can feed into corporate guidance if it persists.
Speaking of utilities, that space actually outperformed on the day. Grid tech pilots, a virtual power plant trial in DC, EPRI initiatives for data center flexibility, and easier storage rules in Massachusetts all came together.
Those policy moves were meaningful. Falling regulatory barriers for storage and pilot programs signal faster deployment timelines, which in turn raises demand for battery materials and grid software.
Right, and that ties neatly into the materials story. There were big flows and project funding for nickel, copper, and uranium, and one briefing cited about $826 billion of ETF movement into metals.
And then you had volatility, like reports of an about 500% spike in tungsten. That's a five-fold move, and it flags liquidity and geopolitical bottlenecks.
So materials were kind of a mixed bag. Heavy capital rotation into critical minerals, but also spotty liquidity and price anomalies.
Exactly. That feeds through to industrials and construction. and could slow green energy buildouts if supply can't scale.
We should talk quick about communications and media. That sector had renewals and content sales, but also layoffs and a legal verdict, which left sentiment muddled.
Investors were parsing growth versus cost. Content wins supported top-line outlooks, but execution risk from restructuring and litigation created uncertainty around margins.
Cannabis was another story of divergence. State-level wins on medical access and funding for psychedelic research, but offset by tightening hemp rules and weak public company earnings.
Policy divergence is the name of that game. Localized upside is real, but sector-wide fundamentals kept the space constrained.
Quick reactions. 2 short ones here. Right.
Short, sharp.
Let's pull back and hit the cross-sector themes the briefings highlighted. First, AI and automation remain the structural growth engine.
AI capital spending was the through line. Tech leadership depended on whether that capex actually translated into revenue growth for enterprise customers. Analysts note that's the key watch point for upcoming guidance.
Second theme, energy geopolitics compressed commodity moves. Short-term shocks tightened margins in transport and industrials while boosting near-term producer revenues.
And third, regulatory events drove idiosyncratic volatility. Crypto exploits and patchwork cannabis rules were prime examples. Enforcement and policy outcomes really shaped price action.
Let me ask you, with that crypto blow-up, where did you see the most immediate cross-impact?
The most visible was in small-cap tech and fintech-adjacent stocks. Risk-off rippled through, and liquidity-sensitive names were hit. Momentum indicates institutional tokenization paths with stronger governance will be repriced more favorably.
Good point. Now a couple of sector-by-sector quick takes. Short bullets, conversationally.
Technology. AI narratives kept capital concentrated in chips, cloud, and enterprise software. Energy. Near-term supply shocks pushed benchmarks higher despite medium-term surplus forecasts. Utilities. Storage reforms and pilots accelerated deployment expectations. Materials. Heavy ETF flows plus episodic spikes pointed to supply fragility. Financials. Commodity volatility and ETF flows changed risk weightings for lending. Healthcare. Mixed clinical and AI operational wins, with regulatory risk still important. Consumer. M&A and AI upgrades offset cost pressures. Real estate. Industrial leasing held up, but credit stress remained a headwind. Communications. Content wins versus cost cuts created a net of uncertainty. Cannabis. Policy wins mixed with compliance and earnings weakness. Industrial. Automation and margin focus continued.
Nicely summarized. A few actionable insights the briefing suggested. Remember, this is informational, not advice.
Analysts suggested reassessing exposure to energy shocks. Short-term upside exists for producers, but medium-term surplus risk remains. For crypto, prioritize operational quality and custody controls. Momentum indicates institutional pathways with audited governance could command premiums.
And for AI capex spillovers, watch industrial automation, cloud capex, and application layer vendors. Materials. Keep an eye on supply chain bottlenecks, since sharp moves in niche metals can squeeze margins.
Plus, follow policy calendars for regulated spaces like cannabis and crypto. Those windows tend to drive episodic volatility.
Quick risk checklist before we finish. Geopolitical flare-ups that keep oil elevated. Regulatory actions in crypto and cannabis. Input price pressure compressing margins. AI governance and potential regulatory scrutiny, and liquidity stress for M&A-heavy sectors.
All of those were called out in the briefings. Data suggests active risk management and selective hedging against commodity and operational risk would be prudent in the near term.
Final takeaways. Wrap this up for listeners who want the headline bullets.
First, the day was dominated by concentrated leadership. AI and grid modernization were the engines, and those narratives kept selective groups bid. Second, energy was volatile. Near-term shocks boosted prices even while longer-term models suggested surplus risk. Third, operational and regulatory events created outsized idiosyncratic swings, crypto's exploit and stablecoin collapse being the most obvious example. Fourth, materials flows and price anomalies suggested supply fragility that could feed into industrial margins. And lastly, policy calendars matter. Regulation and state-level outcomes were real drivers of short-term moves.
Short reactions again. Two quick ones.
Yeah, that tracks.
Honestly, I was a bit surprised by this one.
Same here.
That's it from us. If you want to dig into any specific sector briefing or ask about a headline we mentioned, head to stockalpha.ai. You can submit questions and we'll answer live through our Q&A feature. For more market analysis and deeper sector notes, visit stockalpha.ai.
Thanks for listening. Remember, this recap was informational only. It wasn't personalized investment advice. If you have questions about anything we covered today, head to stockalpha.ai, where you can ask us directly and we'll answer live. For more market analysis and insights, visit stockalpha.ai.
See you next time on Alpha Recap. Good night.